So welcome everyone. Good morning and good afternoon, depending on where you are. Welcome to our webinar series, third installment of Building a Legal Impact Investing Practice, which is brought to you by the Bertha Centre for Social Innovation and Entrepreneurship and the Grunin Center for Law and Social Entrepreneurship. We're really delighted to welcome you back for this third installment. And before I turn it over to the Bertha Centre for some introductory remarks, I just want to take a moment to thank you at the Bertha Centre and to the East Africa Private Equity and Venture Capital Association, Strategos Consulting, Adams and Adams, and again, the Bertha Centre for not only helping us put all of this together and undertake this really wonderful endeavor to expand our programming across borders, but also for hosting folks at your offices across Cape Town, Johannesburg, Nairobi, Lagos. We're really delighted to see the community coming together and this webinar being not just an opportunity to share knowledge, but also to build a community of practice in Africa, the broader region and beyond. So without further ado, let me turn it over to Sue at the Bertha Centre.
Hi, and welcome to everybody on the third in this three-part series. It's been a really interesting and fruitful experience and hopefully a template of how we can deliver some of these partnerships or partnership courses going forward. A big thank you from the outset to the Grunin Center and specifically to Carolina and Deborah, and bringing together really a group of kind of leaders and pioneers in the field that we've been able to tap into and learn from. It's been invaluable for us in our various geographies. That is Southern, West, and East Africa. I think we've reached over 150 professionals thus far, some of which has happened in person at various venues. So welcome to Strategos in Lagos, who's joining us. We've got a group of people here in Cape Town. And I think that had we not used this format, then the likelihood is we wouldn't have reached the number of people we have. And for time-sensitive professionals, this has proved to be an easily accessible format. So thank you for everyone's contribution. Thank you very much to Barry, who's been very involved in the logistics behind the scenes. I'm really looking forward to an excellent session today. And yeah, very keen to see what we're going to learn.
Thank you, Sue. So just briefly to share with everyone the agenda. We will be starting with a panel discussion on blurring the lines of impact and ESG. And we will move on to a panel discussion on governing impact investment funds, followed by a brief Q&A after each of those sessions. But then in addition to that, we're going to allocate an extra 15 to 30 minutes at the end of the webinar if you'd like to stay on to answer any questions that we may not have gotten to during the panel discussions. Also, as for housekeeping items, just so you know, if you're a participant and not a panelist, your audio and your video will be off. So you'll be able to hear everyone, but we won't be able to hear or see you. If you have questions, we strongly encourage you to use the Q&A function on the Zoom platform. It'll be at the bottom of your screen, pretty much in the center. So we definitely invite you to send questions as the conversations are happening, and we'll share those with the panelists to address any queries you might have. And if you have any problems with the technology, feel free to send us a note. Our colleague Johan Starr is on the line and he will be able to support as needed. So thank you to all of you again. And without more, let me introduce briefly our panel on blurring the lines of impact and ESG. The session is going to focus on discussing the potential impact on investor appetite and consequences of blurring the lines between ESG and impact. And in particular, they're going to explore the applications of fiduciary duty, the impact on various reporting mechanisms, and the risks associated with mainstreaming these strategies. We have on the panel today a wonderful group of experts that are actually here in the room with us today. We have Helen Scott, who's going to be your moderator. Helen is a professor of law and faculty co-director of the Grunin Center here at NYU Law. We have Robert Esposito, who's associate at Paul Weiss, Rifkin, Wharton, and Garrison. Quinn Moss, who's a partner and head of private investment funds group and impact finance and investment lead at Orrick, Harrington, and Sutcliffe. And Karen Raz, who's head of environmental and social risk management at Morgan Stanley. So I'll turn it over to you, Helen.
Thank you, Carolina, and thank you to Sue and the Bertha Center as well. As the population of social ventures and the investors who support them continue to expand, so do questions around definition, mission, and measurement. Recently, there's been a lot of talk, writing, and focus on the criteria used to define and evaluate types of socially responsible investing. Today, we're going to talk about two increasingly popular descriptions of investment parameters, and maybe add another one or two. In particular, ESG and impact investing, and our experienced and expert panelists will try to explore for us how they may be similar, how they may be different, and how the use of these parameters may affect social enterprise investing overall. As many of you probably know, the head of BlackRock, one of the largest asset managers in the world, in his annual letter last year, wrote that a company's ability to manage environmental, social, and governance matters demonstrates the leadership and good governance that's so essential to sustainable growth. These criteria, environmental, social, and governance, are collectively referred to as ESG, are thereby playing an increasing role in investment philosophy and decisions, even in the largest companies and across the largest markets. Impact investing is defined by the Global Impact Investing Network, or GIN, as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So both concepts are aimed at expanding the universe of investment criteria beyond traditional financial return to include other kinds of returns and outcomes. Finally, in our discussion, we will add in the United Nations Sustainable Development Goals, or SDGs, adopted in 2015 by the UN member states, which are intended to balance economic, social, and ecological dimensions of development. So we see a lot of converging concepts of how we should look at the investment landscape. And as the world of social enterprises continues to grow, attracting new, larger, and different pools of capital, where we start to see different sources of capital blended in the funding of a single enterprise. And as these enterprises scale, managing these concepts is an important tool for entrepreneurs and their advisors. So we're going to begin our discussion, hopefully, by setting out some definitions of these terms, where you're likely to encounter them, try to identify the investor communities or the pools of capital that use these terms, and their risk profiles. Then we will focus on the question of outputs, which is to say, data collection and reporting issues as they relate to these criteria, as well as the trade-offs among various criteria. As Carolina mentioned, we welcome questions. As always, the more we know of your interests, the better and more informed our discussion will be. So please send your queries to Carolina for us to address. So let's get started with the question of definition and context. What are these terms and where do we see them in evaluating investments, in documentation, metrics? Karen, would you start us off?
Sure. So my definition of ESG, or environmental social governance, is the integration of environmental, social, and governance issues into investment analysis, investment decision-making, investment management, for the purposes of achieving enhanced risk-adjusted returns. So that's a lot of words. Let me give you some examples to put it in context. Someone who's focused on ESG might look at a set of real estate properties, and then they want to look at what is being done to reduce energy, reduce water consumption, reduce waste production, because those all are costs to the business. And if a company is managing those costs well and thereby having a positive impact on the environment, the risk-adjusted returns are improved. Another example of how ESG might be considered, if you look at a mining company might have, depending on where it is, human rights impacts. So an ESG lens would look at the risk of a human rights issue at a mining company and how that might affect, again, risk-adjusted returns, particularly as we see the globalization of corporate impacts being spread through social media. That's a concern that a lot of mainstream investors have. On the impact investing side, I distinguish it from ESG on the basis of intent. Impact investing is about achieving a social and financial objective, and the idea that you can also achieve market rate returns simultaneously. The interesting thing about these two concepts is you could have investments that fall into either camp, but you might also have investments that only fall into one or the other. I think of it as a Venn diagram.
Quinn.
Very good. No, that was a very thorough analysis. And I guess all I would add to it is that nonetheless, ESG and impact often do get confused. Even the early stages of ESG, they thought of it as impact investing. So I think the GIN definition helps sort of clarify what is actually being said by the reporting of each, and also what is the intention. But I also think that to date, ESG maybe in the markets is most well known as kind of a screen. It's a screen for public equities, often using a number of service providers reporting and rankings where they rank public companies relative to each other on how they're performing on these different metrics. And so you might have a public company like Tesla that seems quite environmentally conscious, but it scores very, very poorly on the governance side. So these, whether it's Sustainalytics or the Bloomberg ESG rankings, there are probably 10 very prominent rankings out there that people look at to look at their public equity portfolio. And as investors get more conscious of how they want to invest and with whom they want to invest, these rankings become ever more important in the public equity market. In the private equity market or the private market, certainly when you're going out to buy a property, even before all these terms were used, environmental concerns were always a concern. But now what you have is a heightened awareness of how important it is for the long-term investment profile of whatever you're trying to accomplish to take these things into account. And so the ESG principles are certainly ones that any prudent investor should be taking into account. It's just smart investing if you are a long-term investor, and many institutional investors are long-term investors, and so they've started to do that. But interestingly, on the impact side, there are also now institutional investors that are willing to actually invest with impact, recognizing, even though many in the field say there's no concessionary return, there may need to be a bit of a concession depending on what the capital stack looks like if you are going to make sure that you're trying to achieve an intended impact. But again, more and more investment professionals for institutions are starting to think that that's also an important long-term strategy.
Rob?
I would agree with everything my two fellow panelists have already said. I think I would just make one additional observation, having been in the space for a while now and seen these two areas develop. And Quinn, you sort of called this out in your comments, but it's my sense that ESG began primarily in the equities and real assets space, and we are just now starting to see an increased focus on integrating ESG in the credit markets. PRI has had several high-profile announcements and reports in that regard, and I would say that that's probably where equities and ESG were about 10 to 15 years ago. The impact space, on the other hand, grew out of microfinance and the debt markets or convertible debt instruments in the venture space. And just now, as we see the major private equity players raising their own impact funds, I think the sort of vice versa is happening on that front as sort of an interesting contrast to draw. But I think we are finally at a place now where both spaces are converging on having a handle on both the equity and the debt piece.
So I'd like to come back to something that's been raised by all of you, which has to do with returns and the calculation of returns. And where you see, if you see differences among investors in how they're looking, what returns they're looking for and how they look at returns, whether they perceive themselves as impact investors or just more general investors with an ESG lens. Quinn, you want to start that?
Sure. So I think, again, to separate the two, if I'm a public equity investor, again, an institutional investor, maybe a public plan that has high visibility and a beneficiary base that wants them thinking about these things, I certainly would want an ESG filter because there's a large range of public equities out there. You don't need to be choosing, the poor performers. On the impact side, I am seeing the institutional market coming to it much more slowly, partly because, unfortunately, and it's partly because impact did come out of microfinance and a lot of PRIs and a lot of, frankly, philanthropic money, that people automatically think there needs to be a concessionary return. And that's a difficult concept for institutional investors, particularly if you are a fiduciary and are required to invest for return for your beneficiaries. But I think what is becoming more widely accepted is that, again, if you're a long-term investor and you're trying to achieve a certain impact, whether it's environmental or social or developmental, that there is a way to do it with certain asset managers where your interests are aligned. And so many of them think that their return does not have to be impacted by the fact that they are using this as their focus. I will say, though, that having been at a number of these impact conferences where the recent mantra is no concessionary return, no concessionary return, I came to this market from the affordable housing market and creating opportunity funds that were focused on affordable housing. And my clients are going, what? I now need to compete with people that say I need to provide a market rate return. So it's it's complex because frankly, impact is everything, right? So it's not like it's just one industry. It's frankly an approach to any industry, and so you really need to approach it in that way.
Well, before I ask the other panelists to chime in on this, I think it's worth maybe explaining a little bit about what PRIs are and how so much of the investment community in this area began with essentially not-for-profits and institutions of that sort, because that weighs into the who's really looking for financial returns and what investors are really looking for. So who wants to take that? Rob.
You have to speak.
Sure. So PRIs are correlated to a provision in the tax code that allows private foundations, which are required by law to distribute 5% of their assets each year. Normally, this happens through grant making to charitable organizations, but there is a provision in the code that allows these private foundations to make investments. And those investments will count towards the total 5% distribution that the organization is required to make each year. The Gates Foundation has a large PRI, maybe the largest PRI fund, at least it was a while ago, and has been an active player in this space. And the interesting thing about PRIs is that for, I think, a long time, people just sort of presumed that these were investments that were made with the intention of generating just your money back or, a single digit return. But, it is legally possible, at least, to generate a market rate return on a PRI. I think there are letter rulings to that effect. It is possible to make those happen, although I think that the knock has tended to be they are rather complex and time and cost consuming endeavors for a lot of organizations, and many, foundations don't necessarily have the capacity to engage in that type of activity.
So the PRI acronym stands for Program Related Investing. And it was very important in the earlier days of this current trend of impact investing and focus on outcomes. And as Rob said, this comes from tax concerns of not-for-profit institutions. Who are very concerned about retaining their tax exemption, but also are the kind of institutions where the mindset is not necessarily geared towards financial returns like a financial market investor would have. And so this notions of trading off returns for impact and what Quinn has referred to as concessionary returns kind of got built into the DNA of the impact investing thinking. So now, as we're moving to other sources of capital, which are essentially capital markets type investors that we're used to seeing in other areas, these notions are starting to get shifted. So, Karen, could you talk a little bit more about what you mean by risk-adjusted returns and over what period you're talking about?
So when I say risk-adjusted returns, I mean, the returns, when you do your model for a potential investment, you're going to model out the returns you expect and, adjust those for the risk that you might face. And so, I'm forgetting another part of your question, but what that means for ESG is you're going to look at, the return profile of an investment and what the downside risk might be, what the risk is that an investment goes under, and you would include ESG considerations in there. Another common thing you'll hear in the ESG space is that ESG is really a proxy for good management. And so when you want to identify your return profile, you're going to look at the quality of the management team or the quality of the management at the company to make sure that you're going to achieve the returns that are in your model because you trust that the management team is going to enhance the operations and improve the financial statements of the company. And ESG is a key part of that because you don't want a management team that is going to take shortcuts when it comes to environmental issues and increase liabilities. You're going to want a management team that prioritizes diversity because there's increased evidence that diversity leads to improved performance by a company. And I'm forgetting the other part of your question.
Over the time frame.
The time frame. That's a controversial point. So a lot of people will say that, it's really important for long-term investing to integrate ESG, which is true. But there's also increased evidence that even in the short term, ESG is important for achieving enhanced risk-adjusted returns. And so it really depends on what you're investing in, what the asset class is. I've worked in private equity and I work at an investment bank now, and there's definitely evidence that even in the medium term, you're going to see enhanced risk-adjusted returns if you're focused on ESG. But again, particularly for long-term investors, as Quinn has pointed out, ESG is particularly important when you're looking at 5+ years of an investment horizon.
So I'm talking on
Yes.
one thing, going back to PRIs, even though that was historically a really significant part of impact investing, I will say it continues to be. And so if you look at sort of the new opportunity zone legislation, Kresge Rockefeller went out with their RFP precisely to make sure that this legislation ultimately achieves some of the impacts that it was intended to achieve, and it's not just a real estate development play. And what they've offered through their PRI program is actually the first loss guarantee and a capital stack of an investment that would otherwise not have been an attractive return to the institutional market. And so I think they selected 5 or 6 nominees to help them with this, whether they're an aggregator or a specific project manager. But I just wanted to underscore that it's not, their role is still very, very significant in impact as part of putting together a group of investors at different levels of a project to make the overall returns and bring in the capital that's necessary for the whole project to succeed.
Mm-hmm. Well, that actually brings me to the next thing I'd like to hear from you all, which has to do with how you're likely to see these characteristics reflected in either the negotiation of the investment or the documentation of the investment. We'll get to how you implement that later, but what would one expect to see going into one of these investments? Rob, you want to start?
Well, I think in part the answer depends on what type of an investment you're making and through what type of a vehicle. But since I spend a lot of my time in the private equity space these days, I'll use that as an example. And I think it's a timely one because we're just on the heels of several large fundraisers in the private equity impact fund space, as many of you all on the line might be aware of. KKR just recently made the first investment in its impact fund. Bain and TPG have had funds for a while. TPG is raising a second now, and so there's some precedent out there now in the market for terms that are specific to impact fund PPMs, limited partnership agreements, and other ancillary fund documents, particularly side letters. I would note, I suspect that the vast majority of the bespoke language in impact investing these days lives in private equity, at least in the side letters. It's my understanding that they have attempted to keep the partnership agreements as sort of standardized as possible in many regards, because it's language that everybody knows works. But the key areas of content that I think are focused on in those negotiations are, number one, whether or not there is any attempt to tie the fund manager's performance fee to the impact results of the portfolio. And secondly, I also think there's a lot of time and language around reporting, the specific, bespoke or proprietary reporting programs that fund managers have adopted or put into place that satisfy the LP's requirements of wanting some type of impact measurement memorialized on an annual, semi-annual, quarterly, or some periodic basis.
So I can add, as between investor and company, what I've seen, particularly with respect to development banks, are provisions and agreements that require a company or an investee to comply with international standards like the IFC performance standards. And then similar to agreements between investors and private equity funds, I've also seen requirements around reporting on performance with respect to environmental, social, and governance issues.
Quinn?
Similarly, and I guess having gone through the KKR negotiation on behalf of an investor, I will say that the reporting ended up being the last issue, the thorniest issue, the toughest issue. Each party had a very different concept of how deep that dive should be and how important it should be, and what should happen if the reporting wasn't provided. What should that remedy be? So I think just as Rob was saying, it's a very important part, frankly, of any impact discussion. Even we had a public equity strategy, and it was also the last thing to be agreed on, is how much of the information is available currently in the market. So what can be reflected in a meaningful way for an investor to see how the fund is performing. And it's costly. So the investors in these funds have to be aware that if you're investing in a small company and you're requiring them to report on all sorts of data from every single site that they use, that is something that many of them don't have the back office to do. So it's not a simple thing of saying, this is just a really good thing and let's just all do it. It does hit the bottom line, and people have to figure out a way to do it efficiently. And until the market sort of grows up, it is going to be costly. But I think the argument is that that's why we're doing it now. It's worth the cost. It's just we have to find service providers that can do it efficiently. We need, you can use artificial intelligence to do it efficiently. We're working with one group that does water sustainability, and they have technology that they can plant in the watersheds that they are managing to give them real-time data on phosphorus levels and that sort of thing. Before they could do that, you're putting in monitors, and it takes manpower. So the market will grow, but the reporting ends up being very important.
Right. So you see the delineation of the metrics in the investment documents themselves.
The metrics got sort of more generalized as the negotiations went on, I will say. But I will say also that, again, going back to the public equity market and ESG, so we're mixing them ourselves here, but there are a number of providers. I think Sustainalytics has 70 factors, and many of them have something in that range. And so if you're cross-referencing across a number of data providers, you can get a pretty good sense of the public market on how they're ranked on these other metrics. It is harder in the private equity market. There's no question about it.
So that suggests that we're talking about operations of a certain size before you can actually take on these kinds of investors. When you look at these private equity funds,
Right.
It's simply not manageable to make a lot of small investments.
That's right. So that I think, one thing that the challenge of impact is to scale, right?
Right,
So,
right.
there's lots of really great ideas that get off the ground but can't scale. And so the thought has been to bring in institutional money to help it scale. But you're right, there's sort of this disconnect between the startups and the big money. So the KKRs of the world are still talking about very, very large institutions. These are not smaller funds. Opportunity zones, on the other hand, it can be anything. It can be a very small amount as long as what you're investing is your capital gains. So if you wanted to invest in an industrial oven for your bakery, that scale is possible. But of course, it can be much, much larger.
So you've also talked about these providers, these middle people who are getting into the market with metrics and scores and whatnot. But Rob, you talked about bespoke metrics in a number of private equity investments. Do you see these issues becoming standardized? The calculation of your ESG effect and your and impacts being standardized?
I think there's a better chance of ESG metrics achieving some reasonable degree of standardization in the next decade or so, because I think that in many cases they are applicable across quite a broad range of possible investments and lend themselves to some standardization. On the impact side, I'm not so optimistic. I think that there's still quite a bit of work to do. I know that the folks at the Impact Management Project and other organizations are trying to bring everybody to the table because there are now there's an alphabet soup of standards and different impact standard setters out there that from my perspective are helpful in some cases and not very helpful in others. I also think that sort of the universe of potential impacts that a company could generate is so vast that maybe an industry by industry impact approach is a better way to try to standardize that space, where I think as ESG could be more of a one size fits all type of approach.
And that's what's interesting about IRIS, because they have acknowledged, the GIN's approach to this, that they've acknowledged that you really have to look industry by industry.
Yeah.
And if you look at that industry, that makes so much sense that this would apply, to mining, and it would not apply to, a shop.
Karen, you've worked with large portfolios.
Yes, I believe we're quite a ways away from standardization in ESG and impact. I think standardization across industries for ESG is going to be very, very difficult. If you look at one of the organizations that has tried to, the Sustainable Accounting Standards Board, they even look at ESG metrics in terms of what's material by industry. And, in private equity, one of my roles was to identify metrics that we could have from an ESG perspective across all portfolio companies. And while we were able to do that, the challenge came with the methodology. If you want to calculate energy consumption, how that is calculated differs depending on if you're a hotel or a glass bottle manufacturer, because the inputs are very different. So what we realized is we ultimately were comparing apples to oranges, which made it a really big challenge. There's one interesting development to keep your eye on. It's the formation of a company called Y Analytics by the TPG Rise Fund, and they are intending to source data from external parties, research data, and use that to calculate the impact of a company or an investment. It's early days, it was just announced, and I think that's going to be very interesting to watch in terms of standardization.
So we all know that the capital markets and securities markets love standardization.
Mm-hmm.
And the more you can get standardization, the more you can engage in this comparability analysis. But it still sounds like there's a very high degree of individualized negotiation and concern in each of these investments. So before we take a couple of questions, have you seen trade-offs among these factors between impact and ESG, or among the different, the E and the S and the G factors in the transactions that you've worked on or seen? You mentioned Tesla as a great example.
That's when it comes to mind. But I guess I will also say, and this is not quite
I wouldn't call Tesla a social enterprise, but moving on from that.
So impact has also, in my experience in the last year or two, started to be equated with trying to accomplish the SDGs. And so more and more of what I'm seeing is the way impact being defined in terms of the SDGs and which SDGs. And so,
there are, I think, 71.
There's 17.
But
17, but each of the 17 has its own
sustainable development goals. Yes.
And so they're obviously, the goals themselves are fairly sweeping in the way that they're defined, although the underlying initiatives are more specific. But nonetheless, I think when folks decided I'm going to raise a fund that is focused on certain SDGs, they only would select 4 or 5. You're not trying to accomplish all 17 in a fund. So there's that bit of trade-off that, we're going to focus on, the environmental, the education, whatever the several factors might be. But I haven't really I've seen, like you would in any private equity fund, a definition of what the investment focus is.
Mm-hmm.
But it hasn't really been that we're trading off one impact versus another. I think the idea is to measure a variety of impacts for that specific industry. But, other people's views.
I think if there's a trade-off, it's due to the lack of the most precious resource, which is time. To achieve impacts require time, both in terms of the management of the company and the management of the fund to focus on it. You manage what you can measure, and so measurement also comes at a cost as well. So I think the trade-offs come in that regard. I also think it's not a trade-off, but there can be a focus on one particular impact to the exclusion of others. So the example that comes to mind is the installation of large-scale solar fields in certain countries on land where indigenous populations live. And a company that's very focused on the solar aspect and not thinking about the impacts on the people, on the indigenous populations whose land they're building on, and the rights framework around that construction could overlook that social issue. Not a trade-off, but something to be mindful of.
In vertical farming, for example, which sounds like a splendid idea, one model, they use 1% of what it would take in terms of water from in-ground farming, but they're a huge energy consumer. So, you need to really look at that whole package, plus, what materials went into the manufacturing of the equipment that's necessary for the vertical farming. So, I think one lesson that we've all learned is that you really need to look at the full footprint. I think many folks in the early years looked at specific impacts, but I think now there's more attention being paid to the whole picture.
So how do we approach investors and entrepreneurs who want to be involved in this space?
For entrepreneurs that want to be involved in this space, I spend a lot of time doing that type of work, and a lot of long conversations with folks that are caught up in legal forms and getting certifications of various types. And from my experience, that's a lot of wasted time. Just go build your business, quite frankly, and focus on 1, 2, 3 key impact indicators that you are trying to set out to solve. And they could be SDGs, they could be other metrics that are inherently, producing positive benefits to society or the environment, but don't wear yourself out. If you just have one, that's more than a lot of other companies have, and focus on growing your business. That would be sort of my message, in short, to the entrepreneurs. For investors, I think particularly the institutional investors, the message would be to keep having these conversations with your asset managers. Those folks pay attention because they get written very large checks, and they have to pay attention, and they have, I think, what's happened in the public equities and through shareholder and proxy proposals, and what's happened in private equity over the last 10, 15 years due to the increase of institutional LPs making more demands, getting more sophisticated themselves on ESG and impact. It's been a big driver of where those two spaces are today, and it looks quite a bit different than it did 10 or 15 years ago. There's much more data out there than there used to be, and folks are there's not a bank on Wall Street or a private equity firm in New York that doesn't have some ESG or impact personnel in it now, and I think that's come quite a long ways. I think there's reason to keep doing that.
And I would add also, of course, the wealth management groups that manage a lot of high net worth money or family office money. There's never enough product for those groups at this time. Mm-hmm. But I guess what I would say to an entrepreneur, though, is pursue your passion. Whether it's impact or not, but pursue your passion. If it's impact, there may be a special market for it. But also make sure you're really paying attention to compliance issues, because if you want to draw other capital, people need to know that you're watching your housekeeping. And many feel like they have to move so quickly that they ignore that. And that's, the ones that succeed are the ones that have actually paid attention from the beginning. I think that they've developed good governance from the very beginning.
I agree with everything my colleagues have said. One point from the perspective of the entrepreneur, I would emphasize a point Rob made, which is to think about the Sustainable Development Goals. We're seeing them increasingly used as a framework for defining impact, and having familiarity with those goals and how your business aligns with those goals will be helpful for conversations you have with really any investor. For the investors, to make a point from a discussion we've been having, when you think about measurement and reporting, if you're going to go to an entrepreneur and ask them to do that, think about what systems are going to be required for them to produce that information and that data to you. Reporting is not as simple as filling out a form and sending it through to the investor. To give you the right data and the accurate data, there's a lot of back-end infrastructure that has to be developed that's not always there. So understand what is in place at the company level and what the cost would be and what would be required to get it built if it's not there. Have that be part of your conversation in addition to what metrics you would like to see.
Yes, I think in our earlier discussion before the panel, Quinn, you suggested there's an educational process that has to take place on both sides, both the entrepreneur and the investor, in terms of managing expectations.
That's right, and that's very much, what the others have been saying. Part of that really is knowing the business and knowing how you want that business to spend their time, but also for the business to understand the investor's perspective. The investor's not trying to make work. They're trying to create a partnership where together you're going to actually have a company that can report a measurable impact that suits the intent of the business. But I think it does take education because, again, many come to their business not having exposure to the market, certainly not to all the SDGs. I mean, there are not many that actually probably have followed this advice. So some are actually surprised that they fit so beautifully into these programs. So that discussion is a very important discussion.
So let's take some questions.
Great. We have thus far 4 questions. Keep them coming. So I'm going to read out the first one. How do you enforce non-compliance with delineated reporting/performance requirements? Since you need quote unquote sticky capital, to make meaningful impacts, early withdrawal from an investment is not ideal.
So you alluded to this earlier, Quinn.
So in a funds context, one of the negotiating points was if you fail to provide reporting, and of course we're expecting it to be accurate reporting, but if you decide you're not going to give us any reports at all, then that would actually, after a certain number of instances, rise to the level of cause where we could suspend further investment until we got back to the table and discussed what's going on. That helps in a fund until you're at the end of the investment period, and then, of course, they can go on their merry way. And it's actually more towards the end that you need all that reporting to make sure that they're continuing to build the business and achieve the impact. So that's a very good question, and it's a very sticky question because there's a lot at stake, of course, for the asset manager as well, and so they're not willing to have their whole business shut down on reporting. You obviously have a contractual right that you could also enforce theoretically in court. Asset managers don't take kindly to being sued, as the Connecticut treasurer found out. So you probably wouldn't take that step, but you could expect that the large investors would certainly be vocal, and that it'd be difficult to raise another fund. In a private equity context, the actual investment context, actually maybe you have a better insight into how do you enforce reporting that's required of your clients?
I think it's a real challenge that hasn't been sorted out. I think the approach to reporting enforcement right now is, in the private equity context, is to use the leverage you have outside the contract to get the reporting that you need, whether it be through directors, if you have appointed board of directors, or board observers, or your relationship with management. There's not a lot of enforceable contractual obligations with respect to reporting in the private equity space right now. There's interest in it, but I think in part because of the challenges that you just described, we're not there.
I think that's absolutely right. I would note that in the public equity space, in foreign jurisdictions, there are increasingly in compliance and enforcement of ESG disclosures, to the extent that they're included in public filings, are part of increasingly listing requirements from many exchanges around the world. And that list, I think, continues to grow longer and longer. So, that's quite a lever to pull for a publicly traded company, that they risk being delisted if they do not, in fact, comply with the disclosure requirements that the exchange has set forth. So. I think there is a lot of hope for that as a potential solution to that problem in the public equity space. But I agree with my fellow panelists on the problems in the private markets.
It sounds like it's an iterative process we're talking about, discussing this up front in terms of what reporting you're going to require at the outset, educating the entrepreneur, and educating the investor as to what's in fact feasible, given the structures that might be in place. But it doesn't sound like we're talking about a sort of standard material breach. That's it, finished.
Right.
There's much more of this kind of ongoing iterative process. It's interesting in a way because it's reminiscent of early stage venture capital arrangements, where there's a lot more hands-on involvement by early investors. And one of the issues for scaling here is, are we going to lose that conversation, that ongoing conversation between the investors and the entrepreneurs? So I think that's a hard question, and I don't think we have a certain answer. So what's next?
Where does the burden of M&E, so monitoring and evaluation, lie, as most organizations, especially early stage investments, are not capacitated to do the required evaluations or do not have the required funding?
Well, this raises one of the issues of these third-party providers. Who pays?
Right. Right. No, and actually, it's a very good question. Again, in a fund context, sometimes that's where you first see impact enter standardized documents, is all of a sudden you have a new partnership expense. You don't know what the impact is, but you know you're paying for it. In terms of hiring third parties to come in and monitor whether the metrics are, are being reported in the way that's expected and whether the companies are properly reporting. But it does tend to be the investor's expense, whether it's the fund investors or the fund itself. Where there's no fund involved, I would expect that cost would be absorbed by the parties seeking the impact reporting. It would be part of their investment. It would be netted out of the investment return, essentially. They'd have to be calculating that accordingly.
What about the cost of building the systems that you have referred to by the entrepreneur?
I think it's a negotiated point, and a hard one to negotiate. When you're talking about large investors, large asset managers investing in a larger company, that the expectation is likely going to be that the company bears the burden. But in a more bespoke negotiation with a smaller organization, it would strike me as negotiable. I don't know, Quinn, do you agree?
I agree. I think it's frankly going to depend on how attractive that investment is to begin with. How much leverage the company has, how much leverage the investor has, and what they both want to accomplish together, and whether they're willing to share the risk or to share the cost, or if they feel it's appropriate that it's part of that long-term strategy for the company to be building it in a way that it can attract future capital. There are lots of different ways that it could be approached. Nothing is static, so what are you willing to do in phase one, and what should phase two look like? You might have a fairly in-depth negotiation about it, but I think at the end of the day, it's a negotiation.
Yeah. One other example that might be helpful to bring up in this context is in the syndicated credit facility context. There have been an increasing number of facilities coming out of mostly continental Europe over the last 12 to 18 months that have tied the borrower's interest rate to a third-party ESG rating or score. There's one in the UK that for a real estate borrower, it ties it to the GRESB score of that organization. There are several others in Europe coming out of ING and other institutional banks where they are tying it to MSCI or a Sustainalytics score. And so, there's a whole other conversation about the efficacy of those scores, I think, which probably is beyond the scope of our discussion today. But in those instances, right, when we're talking probably upwards of 20 billion or more in facilities that are outstanding right now that use this tactic. And just to be clear, it's if your sustainability score goes up, your interest rate goes down, on the theory that the company is increasingly creditworthy as it becomes and less risky as it becomes more sustainable. The administrative agent for those facilities, so in other words, the syndicating bank actually draws a separate revenue stream of fees as the sustainability manager for the facility. And so at the end of the day, the lenders are bearing the burden of that monitoring and evaluation cost. So.
Yes, we have time for one more question, then we have three others that we'll leave for next Q&A. So can the reason for the perceived trade-offs be that financial performance indicators / returns are universally understood and attribution is easier to define, whereas impacts, especially social, affect an ecosystem and have indirect consequences that are difficult to measure?
I think that has to be true.
Yes.
that has to be true at this point in the development of these criteria and these investment philosophies. And it relates back to the questions of standardization that we've been sort of talking about, and where investors are looking for some information that's going to give them a sense of where these investments stand. And since there is no sort of commonly agreed consensus about how you measure these things, how you value one over the other. And finance economists will argue that even financial returns are not as sturdy as or agreed to as they seem. I think this field is just at this point way open. So I think there's definitely that kind of trade-off. People love numbers. Investors love numbers. And so as a colleague often says to me, a very sophisticated colleague, numbers are not truth, but investors love numbers. And right now they're a language that capital understands, and we haven't yet fully created the language for capital to understand in some of these other areas. So I think that has to be right.
Yeah, I would agree. Great question and astute observation.
Yeah, absolutely.
Okay, so we may have one more minute
Okay.
to answer one more question. Are social enterprises that are unlikely to scale up overrated as targets of impact investment? Should we rather focus on investments in making large businesses work well in developing countries and so benefit consumers there?
Interesting question.
I think you need both. I mean, I think, from what I'm seeing, for example, my firm's practice in Africa, much of it is actually social entrepreneurs. You're basically, it's again growing out of microfinance to some degree. We're also involved in infrastructure projects, which are huge projects on the other side of the spectrum. But you need that entrepreneurial spirit to be encouraged, that will grow their own businesses and not just bring in large businesses from outside. You really want to be growing. You want to be giving communities the ability to foster that spirit, I believe, within the community.
Yeah, I agree. I mean, at the end of the day, you want great ideas that solve important social objectives, whether that be through a business that scales quickly or a social entrepreneurial idea that doesn't scale as quickly. You're going to want them both. And I think, that gets into the fun in this space. And as we talk about what the objectives are, who the investors are, and try and map all the pieces together.
It will attract different groups of investors.
Right.
So
Right.
you really want to tap into the whole market.
Yeah, it very much depends, I think, on what the investor is looking for. Obviously, a lot of innovation comes from the ground up, and that's always been true. People who understand what's going on the ground and what the real issues are that the community needs to solve. And one of the risks, I think, of bringing in all these large pools of large capital is that the smaller entrepreneurs can be excluded or crushed by the forces of that capital. But big companies can do certain things very well, and other things basically not at all well. And so I think the real question is for the investor to decide what they are looking for, what kind of impact they're looking for, what kind of community they're looking to be involved in, and what problem they're hopefully trying to solve.
Great.
Okay.
So we'll pause there. Thank you to everybody who submitted questions.
Thank you.
And thank you to our wonderful panelists. We're going to move on to our next session. The panel is titled Governing Impact Investment Funds, What Have We Learned So Far? So as many impact investment funds have been functioning and operating for several years, we have the opportunity to revisit the range of governance structures used by these funds to determine what is working, what has proved challenging, and what issues have arisen that resulted in unexpected challenges. So this next panel will examine different governance models being used by impact investment funds and identify lessons learned from the structures, information flows, and composition of governance bodies. Joining us for this panel we have our moderator sitting next to me. It's Professor Deborah Burand, Associate Professor of Clinical Law and Faculty Co-Director of the Grunin Center at NYU School of Law. We also have with us on the line Julie Abrams, Founder and Managing Director of Impact Investing Analytics, Aaron Lewis, Deputy General Counsel International of Habitat for Humanity, Edward Marshall, Partner and General Counsel of Developing World Markets, and Kevin Saunders, General Counsel of Axion. So I'll turn it over to Deborah to kick off the panel discussion. And just a brief reminder to everyone on the line, feel free to submit your questions and we'll try to address them live.
I've just let them know. Okay. So I'm delighted to be moderating this group of panelists. I think the first panel that we just heard from did a nice job of sort of setting us up for where our conversation is going to go. As you could probably tell from just the description of who's on this panel, we have folks here who have been in a position to actually set up impact investment funds. We have folks that have had opportunities to manage impact investment funds, and we have people on the panel, and many of us wear all of these hats, who have been involved in the governance of impact investment funds. So I think this should be a really rich conversation. I do think, and I was sort of thinking about this in regards to the very last question that the last panel addressed, which is are we making trade-offs between the social entrepreneur and what could be happening with the bigger corporations? And I think it might be worth just even thinking a little bit about why is it that people, in fact, aggregate capital into impact investment funds. And I think there is an efficiency that comes. Direct investments outside of an impact investment fund can be relatively small and therefore highly inefficient if you're just doing one investment at a time. And so people are increasingly looking at aggregating capital through an impact investment fund structure in order to achieve some economies of scale, both for those who are the investor, but also for the portfolio companies themselves. So with that, the way we thought we would structure this panel is to talk about how governance has shaped three different parts of the life cycle of an impact investment fund. How it's put together, its model, its structure, how it's then managed, how you operate an impact investment fund, and finally, how exits are managed within an impact investment fund. Both exits from a portfolio company and also exits from the fund itself. So we're going to organize our conversation around that life cycle. And I think the other thing I've asked our panelists to think about is there anything unique that we have observed when the impact investment fund itself has been organized in Africa or is making investments into portfolio companies that operate in Africa? So my very first question for the panel is, as you think about putting together an impact investment fund, is our governance different in any way from a traditional investment fund's governance? Do you see any differences that have made themselves manifest in your experience? And maybe I'll start. Kevin, can I start with you? And then I'll go to Edward and then Aaron and then Julie, just for your thoughts.
Yeah, absolutely. Thanks, Deb. And thanks everyone for joining us. So the Axion, I think in the previous panel, it was mentioned that in some ways the impact investing space sort of grew out of microcredit and sort of that world, and Axion is definitely representative of that evolution. We focus now on the financial inclusion space, and so when we have thought about aggregating capital, our starting point is the question of how can we essentially leverage our own expertise, our own mission through other folks' capital. And sort of historically that's been donor capital, and now the question is through funds. And so to this question of does the impact side of things somehow influence how we think about putting together these funds, I guess the simple answer is it is the starting point and the motivation behind the fund itself. So that's one piece. But how that really plays out in practice has, it's varied for us, but it has led to a few different structures. So I think 10 or so years ago, we were in the midst of a microfinance focused fund, which we didn't use the word impact investing 10 years ago, but I think it was an example of an impact fund. And that was a holding company structure where we had an Axion management team. We set it up so it would be Axion fund managers. We had an active board by the investor group in that holding company structure. And that was meant to both leverage the internal expertise of Axion in the space, to bring in investors and have them learn in a very hands-on way through a not a limited partner scenario, but an active board and an active investment committee made of the investors. And that was successful. We've also sort of had Axion in subsequent funds work as the general partner fund sponsor and really build, even in a limited partnership type structure, a GPLP structure, play that key I guess spiritual role as the driver of and the insurer of impact with the fund, and so how we compose the investment committee, how we define Axion's role as the general partner, including sort of its oversight role in the impact elements of the portfolio, has really been central to how we've put these funds together. We've also thought through sort of a less a co-investment vehicle, which would be a direct extension of Axion's sort of direct investment, but please join us if you want to join in a co-investment vehicle. So that's a slightly different model that we've used in order to, again, leverage, try to leverage what we're doing already through the use of third-party capital. And in each of those scenarios, we've been able to, I guess, luckily convince folks that those models can work for the context we've built them. But I guess just going back to what I said first, the impact side is the driver behind how we put these funds together and the governance behind them.
Terrific. Edward, why don't we go to you, and then I'll pick up Aaron and then Julie. Yeah.
Sure. Thank you, Deborah. And glad to be participating in this panel. And also, I just thought I would start by saying with a little bit of pride that in 2018, my firm, Developing World Markets, which is a impact investing firm that focuses on emerging and frontier markets investments, made our first investments in Zambia, in South Africa, and in Egypt. So we were excited to see some growth and opportunities in all throughout the continent. So you're particularly excited about that. We have generally organized our funds in a traditional format. We manage both private debt funds and private equity funds. On the private equity side, we're the general partner of a partnership. We have an investment committee that is comprised on the equity side of internal DWM partners. On the debt side, we have external committee members as well. There is an advisory committee comprised of investors for our funds that meet to that we consult with on a number of matters, in particular conflicts of interest. And so I think generally speaking, it's pretty standardized. I think one interesting thing that that I'm seeing in the market is something that Deborah was alluding to, which is investors, especially institutional investors, and we deal mainly with institutional investors, do like direct investments. The difficulty is, as Deborah was describing, is that's lumpy and hard to do if you're a pension plan. One of the things that we've done to address that and to attract capital is to set up a structure that is more like a direct investment. And on the debt side, what we've done is arrange effectively securitizations where investors purchase notes in a vehicle, and the proceeds are used to on-lend to companies in a particular segment. So we set up a vehicle 2 years ago to invest in the off-grid solar space and in financial institutions that were lending in the renewable energy sectors. And investors had a strong interest in that, but they wanted transparency into the underlying investments. They didn't want to just put money into a blind pool. So we assembled actually all of the loans, and investors were able to look through that before investing. It was great for the investors. It was not easy for us to pull off because we needed to have everything in place in order to close. It was a bit of a chicken or egg issue we had to deal with. But we have found that investors like that model, and we're continuing to do that in different sectors. So hope that helps answer the question. And I can get into more detail on governance as we continue to discuss.
Thank you, Edward. So Aaron, like Kevin, you are sitting in a nonprofit organization that has sponsored an impact investment fund. And maybe as you talk about how impact investment funds might be different than more traditional funds, maybe also you could address what happens when a fund is sponsored by a nonprofit organization? What did that mean for Habitat for Humanity as you considered that structure?
Okay, thanks. It's a pleasure to be here. Thank you for inviting me. I think looking back at Habitat's history, we're a little bit of an outlier for the group that's here today. We are a public charity that started in the late 70s, primarily focused on how the bricks and mortar housing, really building directly with the beneficiaries. And so we only realized, I think 30 years into our existence, that we were our different organizations, we operate in a federated network. We're actually engaging in investment and working with microfinance institutions to deliver different sorts of services and products to beneficiaries. So we thought, well, maybe we can take that and incorporate it into our model. And that wasn't without some struggle. I think we didn't see ourselves as an impact investment facilitator. So I think there's a lot of culture change that had to take place. I think while there are certain issues that are specifically federal tax exempt issues, such as having a certain degree of control over the use of the funds that are invested, making sure that there's no or only an acceptable amount of private benefit, a de minimis amount, and other things which limit the charity, a public charity's ability to structure these things. We also had the idea that we're also going through a cultural change. And I think, it makes us a little distinct from Action, where I think, Kevin, correct me if I'm wrong, but you started with sort of a vision or a mission that included microfinance and impact investment related activities, whereas we actually had to change some of our cultural norms. And so it wasn't just the tax exempt legal implications that made us take, what I'm getting to is that, it made us take a large degree of control over the board of the fund that we've created, which is, for those who don't know, is Microbuild Fund. Was set up using a lot of debt and equity, mostly debt from OPIC, the Overseas Private Investment Corporation in the U.S. And so we had to retain a lot of control over that fund. We also, I think because we're asking for a lot of concessionary investment, came in as a pretty heavily, I wouldn't say heavy-handed, but there's a lot of support from us as a sponsor in terms of credit enhancement, as well as programmatic and technical assistance support. So to us, government sees, I see the government's structuring of Microbuild is driven mainly by our kind of mission philosophy, as well as tax-exempt legal requirements. And so we've always kind of looked at it as one part of our mission, and making sure that it harmonizes with that.
Thank you, Julie.
Yeah,
that's really helpful. Julie, you've sat on the investment committees and have thought about putting together an impact investment fund yourself. What are your thoughts about how impact investment funds are different from a more traditional private equity fund?
Sure. No, thanks, Deb. And it is a pleasure as well to be here with everybody in various Lagos, Cape Town, Johannesburg, Nairobi, and wherever else folks are. So thank you. So I think that sort of what differentiates ourselves, what is that delta between us? So I guess I'd start with back to Helen Scott had helpfully given the GIN definition of the impact investments or investments made with the intention to generate positive social environmental impact alongside a financial return. So some of the things that are the same is that you need that expertise in financial, legal, risk management, investment, et cetera, and that there is this fiduciary duty to uphold, duty of loyalty, duty of care. And that will vary what that is legally defined as in your respective countries. But for example, in the United States, last year, the United States Department of Labor issued what they called a clarification that ESG factors could be considered in evaluating a fund's risk and return. So that was a legal regulatory ability to look somewhat differently at impact funds. So I think in terms of the fund, I think that intentionality is extremely important. That's true of every fund, but in an impact fund, one of the aspects of that intentionality is the impact. And that in turn is a screening of what kind of investments will be made. It may affect the legal structure as well, in that there could be, for example, for private equity funds, that sort of traditional, at least in the Europe, US 10-year fund model. But if some of these impact investments are smaller, less mature kind of investments, that traditional model may not make sense. For example, there may not be exits when you're getting to that 7-year point. So the fund structure, even though that's looking at exits, you may need to think about, at the beginning. And so, for example, other models may be an evergreen fund or a longer structured fund, such as 12 to 15 years, which is what we call patient capital, or even using what they call revenue-based returns, where you're taking convertible debt, but you exit by getting revenue-based returns, and then you exit without ever converting into equity. And so all of these really would potentially be different because of the illiquidity of the market, and because you need patient capital, and because there isn't enough product, as was referred to earlier in the prior panel. The other thing I think sometimes in terms of, and maybe I'm getting ahead of the topics, but some things, there may be specific veto powers related to mission and impact, and specific minority rights, sometimes disproportionate representation and decision making, some kind of stipulations on the kind of exits allowed to protect mission. So some of those would affect some of the structures. And then lastly, I think in terms, and this was addressed somewhat in the last panel, excuse me. So the whole measurement of impact does cost money, does take time. And so sometimes the economics, that changes the economics of the fund. And so again, so for a traditional, private equity fund that's a 2 and 20 structure, meaning 2% fees, that 2%, particularly on a small fund, smaller fund may not cover the additional incremental cost of measuring impact. So sometimes some impact funds may have a higher fee structure, partly because they're smaller and so they don't have the scale, and partly because that impact measurement does cost, as was addressed, noted in the last session. So anyway, I'll stop there and we can add further later. Thanks.
Sure. So I'd like to go into this question of structure a little bit. And so Kevin and Edward, I'm going to focus this question on you, and then I've got one for Julie and Aaron. Do you think, as people are putting together an impact investment fund, that choosing a closed-end fund, and for those who haven't heard that term before, what we mean is a fund that has a clear expiration date where everything's rolled up and the money, the fund ends and the money is sent back out to its investors. Do you think that structuring a closed-end fund, which is much more typical of a private equity fund, causes an impact trade-off? Kevin or Edward?
Yeah, sure. That's a great question. Let me just start by saying that, because DWM is a for-profit, we're mission-driven. So we're a little bit different. We invest in similar sectors to Axion, but we are, coming at the industry from a for-profit perspective. In terms of our investors, we're generally looking at institutional investors to come into our, private equity funds. And we don't really see a choice. It's got to be closed-ended. And so we're starting from that, it's a given. It's going to be a closed-ended fund. I do think there's a potential trade-off at the end of a fund's life cycle. We're actually at that point in our first equity fund, which was launched in 2009. Sorry, it's been so long ago. And we have exited all but 3. There are 16 investments. We have 3 remaining. And, there's pressure, obviously, to deliver. We want to close out the investments because our investors expect that and need it. And so, we're actually first and foremost looking to make those exits. We haven't actually come in, with the 3 remaining investments, we haven't actually found there to be a conflict from the impact investment side. But, should one emerge, I think we would find ourselves in with a difficult situation of, selling or not. And I think given the fund that we set up in 2009, we need to focus on the return first for our investors and exit. So,
yeah, no, I think even though we Axiom is like Habitat, a charity, and we are driven first by the impact side of things. I guess similar to DWM, it is very, very difficult to get investors to sign up for a fund with no exit horizon. And that is, I think, one of the challenges of direct investing itself into the markets that we're talking about it's very difficult for larger institutions or people without sort of active investment strategies in those regions to wrap their mind around an investment thesis. First of all, understanding the market and the companies. Secondly, how do they ever get their money back? And so for us to go out and say, to offer an open-ended fund probably wouldn't, we would have difficulty raising money because of that. But I think the flip side of that, though, or maybe the corollary, is that the starting point of our impact thesis is that we do need capital to flow into the businesses that we think that will have impact if successful. And so if the closed-end fund structure is what channels that impact, perhaps there is some tension, and this is, I think, what the point of the question is. Perhaps there is some tension at the end of the fund's life about how, if we are trying to exit, does that align with the point in the company's life where we do need to be exiting? That is something we pay attention to. But our experience has been that one, as we've proven that these companies can be viable, can be scalable, can be attractive from an investment point of view, we've often, more often than not, we've seen potential buyers, even investors in our funds themselves who have gotten to know a company over time, have gotten to know a market over time. Sometimes they end up being the buyers. So the handoff from the funds to whoever buys sort of the asset from us, we've not actually seen that trade-off play out in a negative way for the companies. On the front end of the fund life, though, it is a bit because we can't predict. I do think that tension exists.
Yeah. So Julie and Aaron, I promised you that you'd get a structural question. So you both are involved in the Habitat for Humanity Microbuild Fund. And that, as I think Aaron pointed out, but I'll just repeat, it's a very highly leveraged fund, meaning that the fund itself borrowed a lot of money in order to bring that money into the fund and then on lend it. And so that's another structural question, right? Which is, instead of having a fund that is just funded itself with equity, but is bringing in a lot of debt, do you see any implications for an impact investment fund's ability to meet its mission, its theory of change goals, when in fact it is itself highly indebted. And any thoughts about whether there's an impact trade-off there if you were looking again at putting together an impact investment fund?
Right. Thanks, Deb. So the fund Deb is alluding to, the microbuild fund, is highly leveraged with money from, as Erin had mentioned, the OPIC, Overseas Private Investment Corporation, which is the U.S. government's development and finance institution, which has as its mandate to, have impact in these various funds. But I would say yes, short answer, that it does have a lot of effect. I mean, any of you in the audience who've worked with, extremely highly leveraged funds, that has very much, drives some of your decision making. And, we have that money to pay back at a very fixed date and when the fund closes. And so that affects, we're still a few years from that, but that very much affects our decision making, so that on the one hand, we want to have very high impact. It's a debt fund, so in the debt that we lend out and on lend in the fund. But so that's important, and that's one of our criteria. But at the same time, I think, it's natural that you might become more financially a bit more conservative in decision making as you see the clock ticking and there is that closed-end fund and you have a lot of debt to repay, and you still want to this was a demonstration effect fund for microfinance housing globally, so we want to show that money can be made in microfinance housing as well as having impact. So we're under pressure both to get our financial returns and also to show that this is doable, because we want to crowd in money. We want to attract other investment in this area. So I guess I would say yes. And even in the just commercial sector, the more highly leveraged you are, that really drives some of your decisions. We do, of course, as I said, feel pressure of the importance as well as that financial return for the impact. And so we're not foregoing that, but I think that as we get closer to that finite end date of the fund, those decisions will be more and more important. And since some of our loans tend to be somewhat longer tenor because they're for housing, some of those decisions are coming now. So hope that answered your question, Deb.
Yeah, Erin, anything that you'd like to add to that?
Yeah, I would add one thing, and it's, while we've been lucky in that OPIC was, I think, very aligned with the our vision for the microbuild fund. It's a demonstration fund, and we wanted it to be adaptable and flexible as we progress through its term, to deal with different kinds of institutions, not necessarily MFIs, to deal with different kinds of investments in these types of institutions, which may be necessary because of local law. And then we found that while I think OPIC was sympathetic to what we were trying to do, each time we needed to adapt a little bit, which is necessary in this kind of fund, we had to go back to OPIC, kind of explain to them what we were doing, why we were doing it, what the benefits were, what the risks were, of course, and sort of wait on their approval. And so while I'm certainly empathetic to OPIC's need to control their hedge the risk on their investment, it did certainly impact our ability to kind of be nimble as a fund.
I'm going to ask one more question about how we structure and put our governance models together, and then I think Carolina tells me that there's a question related to this first part, which is how you structure or sponsor an impact investment fund, which I'd like to take. But before we get to that question, I know that the microbuild fund has an independent director on it because, in truthfulness, it's me. But I'd like, and so full disclosure, let's, at the risk of this becoming a discussion about whether or not I've been effective as an independent director, what do we see is the value or the challenges of having independent directors embedded into the governance of impact investment funds? And I guess I'm going to first start with Kevin and Edward. Do either of you have independent directors involved in the governance structures of your funds, or is that something that only microbuild has?
For Axion, we currently don't, I guess we do have the fund. In one of our funds, there is a sort of a third-party fund management company. They spun out of Axion a number of years back. They have representation, and then we as the general partner have representation. Now, who we choose to put on that in our seats on the investment committee, I think currently we have our chief investment officer and then an advisor to our board of directors. He's not formally a part of our board of directors, but he's an advisor who comes from the venture capital world. So while he sits in a quote unquote GP seat on the investment committee, he does bring the type of experience you often would find in that independent seat. So we don't have that. I think the challenge for us is that we do want to maintain, again, our starting point is impact, and we want to maintain sort of the balance between the impact view and your traditional sort of investment modeling and return view.
Yeah, in DWM's case, we have independent directors of our committee members on our debt side, but they're really evaluating credit. They're not evaluating impact. So, that's just the way we're set up. On the equity side, on the private equity side, we have not had independent committee members that have been partners of the firm. However, for our third equity fund, which is focused on displaced persons, we are partnering with an outside group that will serve as an advisor to the fund, an independent advisor to the fund, and they will be working with us to create the impact framework that we'll be using for this specific concept. And they'll actually also be working with us to set up a technical facility for enabling portfolio companies to measure their impact. That, I think, answers one of the questions from the prior panel. That's something that we're seeing as that can be particularly valuable for investee companies. But anyway, going back to the question for this third fund, we are seeing the value of having, and I think investors that we've been speaking to are seeing the value in having an outside party participate in especially the impact evaluation.
But Ed reminds me that while we don't have voting independent directors, members of the ICs, we do have a number of advisors that play a role on each of our ICs, and sometimes we find that it's an LP actually in the fund who again, one of our sort of missions is to bring more investors into this space and to educate them, and and they often have specific market experience, so that's helpful. But we also have different. We work in the financial technology space in many ways now, or the financial service provider space. So sometimes we have independent advisors who bring, for instance, insurance experience that can come into play. So we do have a lot of voices with a lot of expertise, but the voting members aren't independent.
Yeah, so I'm going to open this up to Aaron and Julie. But just to make sure everyone understands the language we're using. So you could put an independent director in different places, right? So I'm an independent director on the board of the Microbuild Fund. So that's that board of directors. In the last several years, I've been invited in my role as a director of the board to sit on the investment committee. And so when Kevin says IC, he means the investment committee. And so that's the group that is making the decisions about where we're deploying the money that's coming into the fund and how that's going forward. So now I sit there also thinking about and giving input into the investment decisions. Up until a couple of years ago, I just sat at the board level as an independent director. So, Julie, have you ever been an independent director? I know you are on a number of boards, but you often have been hired to represent an investment interest.
Right. Thanks, Deb. So yes, I have been in both capacities. So for example, on Microbuild Fund, I was appointed by a mid-year network. For example, Calvert, now called that Calvert Impact Capital, I was fully independent. I think there's a great value for some role of independence as to the models you've been hearing about. Could be an advisor. The person could sit on the investment committee at the board level, et cetera. I do think back to the original idea of having aligned approach. Obviously, anyone who is an independent advisor, director, et cetera, should have very aligned approach to, especially for an impact fund. That said, I think sometimes you can bring outside expertise and an external view, people who are not fully immersed in either the fund, the organization, sponsor, et cetera. So I'm personally a big fan of an appropriate and aligned and highly skilled for what is needed for that fund, some kind of independent roles.
Mm-hmm. Erin, I've never asked you this question. Why did you decide to have an independent director? Please don't describe why you decided to have me. Just why did you have an independent director?
Well, as I explained earlier, we had sort of a culture crisis and wanted to demonstrate to both our board of directors and our organization and the network that we were sort of in control of this situation. Having said that, we realized we're not fund managers and we're not experts at impact investment, and not all of us at Habitat. And so we needed outside expertise. We also needed to, because we were bringing in outside investors, want to establish sort of a legitimacy. The thing about independent directors is that they're not just going to follow and do whatever Habitat says. They're also going to hopefully counteract confirmation bias, where we just assume that housing is the most important thing to everybody, and it's just that all data supports that our product works. They can test that hypothesis. They can explain how it might not be as right as we think. And so it's sort of both for the legitimacy, and sort of expertise, as well as sort of for scientific reasons, just to keep ourselves honest about what we're doing. We wanted independence, and that, having said that, the only inconvenience, that's all I'll say, is to independence is that they're independent. So and so sometimes things take more time, or what we thought was working, we have to go back to the drawing board. But I think that's a healthy process, and that's why we love all our independent directors, especially you and Julie and it's bringing a team together so that everybody can have an honest dialogue about what's happening.
Yeah, thank you. So, we're going to change this up a little bit, because one of the things that Carolina is telling me is that we're getting some great questions coming in. So what I'm going to do is I'm going to ask her to give a couple of those questions that relate to how you structure and set up a fund and its governance. And if you could give me a couple of those questions, let's take those now before we work on what happens when you're actually operating a fund and the role of governance. So do you want to give me one or two?
Great. Yeah. So one of our questions is, can the panelists discuss their experience with foreign exchange risk? For example, investments in Africa can be subject to foreign exchange risks. Do investors want to be hedged?
I think this is a great question for Julie and Erin, because I know this has come up in the microbuild fund. And so why don't we start there with what we've done to try to manage foreign exchange risk and how we've brought in some philanthropic capital to help address that.
Erin, do you want to start specifically with microbuild? I've done a lot of foreign exchange risk on other funds, so I'll broaden. So why don't you start with microbuild, if you don't mind?
Okay, thanks. So we did start initially with, and we still do this to a certain extent, hedge foreign exchange risks sort of in the traditional way through a third party. And we just do that. We select certain currencies that we feel are risky enough to go into that. But the main, I think, unique thing that I can say from microbuild is that we were having trouble breaking into certain economies because of the foreign exchange risk. And one of our donors, one of our philanthropic providers who were supporting the fund, not through any sort of equity, but just capital to Habitat, the charity, that we then turned into equity, offered up a pool of money to just say, here's a certain amount of money. You basically diversify this across several buckets of currency so that if there is a loss, this fund, this separate facility, I guess it's it's not a formal fund can be used to recuperate that loss.
Yeah, that gave microbuild a lot more room because it had been just investing in dollar-denominated instruments and then putting the cost of the hedge on the institution, the portfolio company. So this allowed, I think, microbuild fund to give more affordable financing and also help protect the risk. Julie, do you want to say a word about some of the other ways you've seen people address this?
Sure. So I think debt versus equity funds, a bit different. So with the debt funds, and particularly when there's on lending, such as microbuild and other funds I've looked at, I think it's very important. So often there are covenants that the fund will require that there be no more than a certain amount of exposure. However, in reality, in some cases, particularly for on lending, such as microfinance or other banking institutions, that sometimes means the consumer. So that becomes an impact question too that needs to be looked at. So, for example, if the fund needs to stay, very limited to foreign exchange risk exposure, they may lend in hard currency in countries where people are not operating in those currencies, and so really you've passed on to these consumers, which I think from an impact standpoint and a moral standpoint is not right. And so that needs to be looked at, kind of where that risk resides. It also eventually, in that kind of scenario I just described, becomes a credit risk, because if someone isn't paying you back because of foreign exchange, it's going to come back and hit the fund eventually. So I think looking at how to hedge it affordably is important. As Erin had mentioned, I'm working currently structuring a financing facility where one of the biggest concerns of the portfolio company was that foreign exchange risk. And so, you can do various structures where, depending on who will either assume the risk or you hedge it. And then just lastly on equity funds, so if it's an in-country fund where, all the portfolio companies are local currency and the fund has hard currency investors in dollars, euros, what have you, the reality is that some of that, particularly for, say, a 10-year fund, it's not typically going to be hedged. And so independent of how well the portfolio does in the currency in which it's investing, the reality is you may have an upside or downside at the end just when you're exiting, translating those gains into the foreign currencies. And that's true of any emerging markets private equity fund foreign exchange risk. But I think it's really important to be candid, transparent about it, and look at the impact, particularly on both the portfolio companies or beneficiaries on foreign exchange risk. Thanks.
I'd like to add a little bit too, just based on our sort of experience in the market. On the debt side, investors that we're dealing with across the board do not want local currency, do not want any local currency risk. That was not the case, 8 years ago, 10 years ago. Or maybe 12 years ago when emerging market currencies were doing great, but there's been a enormous shift away from local currency exposure. And on the other hand, in many of the markets where we're investing, for a lot of good reasons, borrowers don't want to take hard currency; they want a local currency. And we've been caught in the middle. There is a facility in the U.S. that everyone on this panel knows about, MFX, which provides hedging for exotic currencies around the world. So that can be quite useful. We've availed ourselves of it for various facilities that we've used. Then it gets really complicated because in Europe, we manage funds that are based in Europe, and in a number of cases have been unable to transact with MFX because it's in the US and it's unregulated, and just you have to jump through many hoops to be able to access MFX in some cases. But it's really the number one challenge we're facing on our credit side is managing investor demands on the one hand and borrower needs on the other. And as Julie was talking about, you have end clients in the case of financial institutions and local currency in these countries that shouldn't be taking hard currency, exposure themselves.
Thank you. Give me another one.
You've spoken about structuring debt and equity models. What experience or advice do you have with blended finance models?
So actually, the microbuild fund is a blended finance model. So, but let's make sure that we're sharing the same definitional terms. So by blended finance, what I mean is where you have different sources of capital where either philanthropic capital or official capital, public sector capital, is catalyzing private sector capital. And so what's interesting in some of these funds, particularly the ones that are sponsored by nonprofit organizations like Axion and Habitats, is that it's easier for them probably than Edward to capture at least philanthropic capital that they can use to support the more profit-oriented capital that they're trying to get. Yet, even for a for-profit fund, when you can catalyze things like the OPIC money, which is a U.S. government development finance institution, that can, and in some cases, be a way to leverage other sources of capital. So we are actually talking about some blended financing. It's challenging, right? And it's not always available to every type of fund. I don't know if anybody wants to say a word about the challenges that come when you have multiple types of investors we talked about multiple types of sponsors, but investors in a fund. Anybody want to talk about an experience they've had where the LPs are both some looking for commercial returns, some looking for subsidized returns, some just wanting a return of capital, and how that has played out and how you've thought about your fund management?
I can take a crack at that and happy to hear from others as well. I've been working on various blended finance transactions for about 15 years, so I've seen a lot of different ones specifically. So I guess one thing I would say is that there's a role for different types of risk, return, and impact. And so that, you know, in the capital stack, figuring out who wants to do what can be important. There's an organization's Convergence.finance, which is trying to promote blended finance. So if those who haven't heard about it may want to look at that after this webinar. But basically, I've been in situations where there'll be a more philanthropic investor that actually wants to take a higher risk tranche of some investment structure, be it a fund or other facility, and they will intentionally try to do so that they're a first loss, and that therefore more commercially capital seeking less risk and higher return will be willing to participate because they've got that protection. I've seen blended finance where literally it's a debt investment, but it's a blended rate where there's a higher return requirement from a more commercial investor and a lower rate. And so the end debt rate to the borrower, excuse me, is that literally blended rate. And again, I think the main thing is that you develop this capital stack looking at what is the appropriate risk, return, or impact. And these philanthropic investors, particularly I think foundations are increasingly, US foundations at least, are increasingly looking at basically taking that more higher risk, first loss, concessionary or no return position. The other thing I've been involved in is where there's sort of a two-part facility where there's debt and then there's alongside it a guarantee facility, which is a legally separate structure. However, if there's significant losses in the debt facility, that guarantee facility will kick in. And then certain investors are in the guarantee facility, certain ones are in the debt facility. And again, it really is, you want to match the profile of risk and return and also impact, but particularly risk and return to the investor for the appropriate place. But the idea is to crowd in as much as possible the commercial capital and whatever that would take. Thanks.
Kevin, do you want to talk about Axion's experience with bringing different sources of capital with different return expectations into funds or investments?
Yeah, and it's interesting. I was thinking through sort of over time how we've dealt with that. I think I mentioned earlier, one of our missions is to be catalytic on the capital side, meaning we want more and more people in sort of across the capital spectrum, or the investor type spectrum, to be to ultimately find that this is a great place where we play to put their capital to work. And so I think what we've seen in our early funds, primarily you had DFIs, the development financial institutions of various countries or multilateral finance institutions like the IFC. They're the types of people who would get most excited, and perhaps that's because they're most knowledgeable about the markets and the sectors we operate in. But we've been able to sort of move, so starting there, and then perhaps a couple of individuals who already were excited about Accion's mission and were willing to take what was then a risky investment. I think we've been successful in showing that this is a place where capital should be placed and can successfully be placed. So in our subsequent funds, we've not tried to tier sort of the risk levels of and return levels of certain types of capital. It's been in sort of pari passu structure in all of our funds. And that does lead to conversations with certain investors about or a lot of focus on the investment theses of each individual portfolio investment, how we view financial returns alongside the impact. But we've been successful to date in getting everyone in on an even basis, despite having at this point in our funds a wide range of investors, from the development financial institutions to family offices to even pension funds. So if you think about that spectrum and sort of how they very differently approach investing space, somehow we've been able to take our prior successes both on the direct investment side and in the fund side and be able to tell a story that gets them all comfortable coming into the same bucket of capital.
You know, it's interesting. I think I want to draw this back to the topic of our conversation, because I think it's really a great question, which is, how does that play out in governance issues? And one way I see it sometimes playing out in governance is I've seen the board say, which is heavily predominant in the fund I'm thinking about, on the more donor-oriented, mission-oriented side, pushing the investment committee to take riskier investments, financially riskier, because they're like, well, wait a minute, we're here because of the impact. And so one can imagine, as the board might have competing interests, those conversations about the risk appetite that the investment committee has, it can have some real interesting implications of pushing investment committees one direction or another. Any reactions to that comment or thought about how this plays out in governance? And Aaron, is that you or Edward?
That was me. I was just going to say, on a slightly different note, we're working actually with Convergence on a securitization structure that's a blended finance model. And it's like the structure I described before, where investors have transparency into the underlying assets up front. It's interesting to see the dynamic play out among the different tranches of investors. And there is a first loss piece that's going to be invested by foundations, and their motivation for investing will be primarily impact. And that's obviously pushing the origination piece at, for the vehicle. So, looking at the underlying assets, they want to know, about the impact up front. They're not going to come in if they don't see it. And meanwhile, you have, senior or mezz investors that have a slightly different view, and that's primarily driven by credit risk. So it's a very interesting balancing act taking place, because of course the first loss piece helps get commercial capital comfortable with the risks. But that first loss piece, investors coming in with that first loss piece want it to be catalytic on the whole. They want to see that there's going to be real impact, and they're looking for us to demonstrate it. But from a governance perspective, it's all being resolved up front, because they're able to look and decide for themselves whether they think it meets their criteria.
That's interesting. I'm going to switch ourselves to another important governance issue, which is managing conflicts of interest, because I don't want to end our conversation without addressing that. That's always an issue that's thorny, and it's definitely within the governance purview within any impact investment fund. So I'd like just to talk about a couple places where conflicts of interest sometimes present themselves in an impact investment fund. And the first one I'm going to sort of throw towards you, Kevin, which is, what are some of the ways you've thought about conflicts of interest and managing conflicts of interest? Because remember, we're not always, you might see a conflict, that doesn't mean you don't have it. The issue is, how do you manage it appropriately? It's not always an avoidance strategy. How have you managed this where you have had Axion has had a pre-existing relationship with a portfolio company that you're putting into one of your investment funds? How have you worked through that issue?
Yeah, we've approached that specific question in two ways. In certain cases, it's been explicit in the offering to investors that we have certain assets, certain portfolio companies that we are essentially warehousing for the fund itself. So we sort of lay those assets out, allow potential investors to diligence them, and so their decision to invest or not in the fund is essentially the conflict of interest waiver process built in. So they have an evaluation of those warehouse assets, and if they choose to invest, they're saying, we're comfortable with the pricing, we're comfortable with the terms on which the fund is accepting these assets. So I think that's a very particular type of sort of asset. I think the probably the more complicated, but I guess what is handled by us in a fairly standard way is the situation where it's not a warehoused asset. The fund has been put together, and Axion has a pre-existing, typically investment relationship. Although because Axion also has sort of technical assistance relationships and contracts related to those with a lot of companies, sometimes that can create a conflict. And the way that we've set it up quite explicitly, because our investors know we're involved in this way. They know we invest directly in a lot of places. They've asked for clarity on this, and we take any sort of investment into any of those companies where we directly have an investment or a business relationship, or even if another one of our funds has an investment. So that can be an intersection at certain points as well. Those decisions, if they make past the investment committee, go to the LPAC, which is the Limited Partner Advisory Committee, so that the investors themselves can make the decision about whether to waive the conflict. So we have been very sort of clear that anytime those conflicts come into play, that the investors, through the sort of Limited Partner Advisory Committee, composed of investors, has to say yes to the transaction for us to move ahead with it.
Edward, I'm going to ask you a conflict of interest question too. So Developing World Markets manages multiple funds, and sometimes you've got the same portfolio company in several of your funds. How do you think through your conflict issues if you have to be thinking about, let's say there's a weakness in that portfolio company's performance, and you've got two different funds that you're responding to, possibly slightly different covenants and ratios. What, as a fund manager, how do you manage those types of conflicts?
Yeah, no, it's a very good question, and I'm dealing with it regularly. So the first thing I would say is that when our approach to investing is that the fact that we have both debt and equity funds investing in the same sector is an overall benefit to investors in those funds. Now, the funds are generally separate. So the equity funds are pure equity and the debt funds are pure debt. But it's part of our value add in our view that we're investing in all layers of a company's capital structure. That creates an inherent conflict or potential conflict if you are investing, one debt fund's making a loan, and it's a portfolio company of the equity fund. So the first thing we do to address that is disclose it up front to investors. So that's in the fund documentation that investors would review in the debt fund or the equity fund. They're aware that there is a potential for other funds to be investing in the same company. That doesn't resolve the conflict if it emerges, of course, but at least is an important disclosure item that I'm particularly concerned about. Then there's different thresholds for when we might make an investment like that, where there's an equity position where we're looking to make a loan, but we will do it, and we run the process separately. We have debt teams and equity teams that are separate, but there's no firewall between them. There is communication flow. And ultimately, in a situation where there's, again, a loan being proposed to an equity portfolio company, run it through the, standard investment committee process, and it's approved. Now, depending on the fund, we will go to either the advisory committee of the fund or the client directly before making the investment. In most cases, but not in every case, depending on what agreements and arrangements we have in place with funds. But we have, and I would expect continue to make loans to equity portfolio companies. Then the issue becomes what happens if there's a deterioration in the company or in the business or its prospects. And what I've created actually is sort of the bright line would be in any workout scenario where creditors are convening informally or more formally, we go immediately to the client of both the equity fund and the debt fund, and disclose the matter and get their consent on how to proceed. We actually haven't confronted this situation before, thankfully, but were it to occur, I think we would take instruction from the client. We'd obviously advise them, but I think we take instruction. It could be that we separate the teams and make sure there's no, communication between them. We may hire someone outside to take on the position on behalf of, one fund or the other. But we would ultimately consult with our investors on it. And sorry, it's a bit of a long answer, but the other conflict though that's similar to this is that we have multiple debt funds with similar strategies. They're not identical, but they're similar. And generally speaking, we need to allocate opportunities to each of those debt funds. And that actually can present quite a challenge, but it's basically something we have to adhere to. So we're generally speaking going to our different accounts or funds and offering an opportunity that we've approved through our investment committee process, and then allocate based on formulas that we've set up with the different funds. Again, that's all has to be disclosed up front. And if we're deviating from that, we're going to the funds advisory committee, or we're going to the clients directly to get their consent to a deviation where we wouldn't share a deal, for example.
Thank you. I'm cognizant of where we are in the hour. So Carolina, do you want to give us guidance as to what we're going to be doing next?
Yes, thank you, Deb. So we'll end the formal webinar, and I'll share a couple of final remarks, reminders, and a couple of invitations with everybody that's online with us now, but we will stay over for an extra 15 to 30 minutes to address the wealth of questions that you've put to us that we haven't been able to get to yet. So just to flag a couple of things that might be of interest to those on the line, we would love for you to save the date for our annual conference that's happening on June 4th and 5th of this year. It's on legal issues in social entrepreneurship and impact investing in the US and beyond. We host that on an annual basis, and it brings together over 300 participants, including practitioners, academics, policymakers from all over the globe, to talk about key developments, legal and policy in this field, and to share resources, collaborate, and help us build this community of practice. We would love to see your organizations and your own work represented at the conference. So we strongly encourage you to save the date, and we'll share more information via email at a later time. And one other final invitation we'd like to make is for any lawyers on the line or groups that know of lawyers that are working in the field of social entrepreneurship and impact investing to consider applying for the Grunin Prize for Law and Social Entrepreneurship.
Today.
Yes, today. So the deadline is today at midnight. So anybody that has not heard about this or that's in the process of applying, make sure if you can to do it by this evening. We're really looking to recognize the role that lawyers play in designing, implementing, and advancing social entrepreneurship and impact investing solutions. So we hope you'll apply. If you have any questions, feel free to reach out to us. If you have anyone that you want to nominate, please do so as well. So with that, we'll wrap up the formal webinar. Whoever can stay on, we strongly invite you to. We're happy to address additional questions. And one final shout out both to the Bertha Center for being such a wonderful partner and putting together this webinar series. It's been an absolute pleasure to work with you, and to each of our co-hosts in different venues across Africa. The East Africa Private Equity and Venture Capital Association, Strategos Consulting, Adams & Adams, and of course, again, the Bertha Center. We're delighted to have partnered with you on this and look forward to bringing back the webinar series later this year. Okay, so without further ado, let's hit those questions that have been asked over the course of the last couple of hours. So another question for the current panel is, besides catalytic first loss guarantees, which other security mechanisms do you employ at a fund level as a direct investment? So that's for you guys.
We've got a little bit of that, I think, from some of the different structures that Edward's exploring, but anybody else have some other thoughts about what they've observed?
I mean, just briefly, I mean, there have been guarantees both in the capital stack and legal separate structures that guarantee it. But additionally, there also some investors will take a fixed return. Some of them may actually put in 0% return, just capital preservation in nominal terms, and or a lower rate of return than others, again, to incentivize the more commercial investors. And I have seen that where those are literal, cake slices in the capital stack as well.
Just one interesting development that we've seen is in Myanmar specifically, there's a facility being set up to, it's similar to what Aaron was describing for microbuild, I think, but it's a pool of capital designed to offset, losses due to FX. So interesting though, it's at the country level and it's, designed to, attract more capital into the country. But deal with the FX risk, and especially because of exchange controls that apply in Myanmar, making it challenging to lend into the country.
The other thing we talked a little bit about, sometimes there are these sidecar technical systems facilities, and while that isn't exactly direct security, I think that it can often help to ensure success for the portfolio companies or debt recipients, so that it is a benefit. It may not be a direct sort of traditional financial product, but I think it very much contributes to helping the more commercial, any of the investors, but particularly those seeking more commercial investment. And that's generally purely grant funded. So that's something it's a little less traditional in a sort of capital stack look, but should be factored in.
Yeah, I was going to mention that is part of how we do operate with many of our portfolio companies, and oftentimes, particularly with the development finance institutions, this one of our investors is often the funder for our technical assistance program with any particular portfolio company. So I do think it's in how we sell our relationship with portfolio companies, it's definitely a part, but as Julie said, it's not sort of what people typically think is part of the capital stack, but for us it's essential.
Right. And I've also seen where some of the more not necessarily philanthropic investors, will take time not in a technical assistance facility, but they'll provide a lot of post-investment support. I've been part of that support in some cases with all sorts of things, sales expertise, finance expertise, production expertise, product design, et cetera. That again, it's a form of pro bono, technical assistance. It's not even called that. It's really just they're providing that at no cost as well.
Terrific. Next question. How do you ensure the impact continues after the closeout? Or is it okay not to know what happens after the fund closes?
This is terrific because because of time constraints, we didn't get to the how do you close down a fund and what is a responsible exit from the portfolio companies as a fund, a closed-in fund is finishing its job and pulling its money out. Any thoughts there?
Well, I don't think there's probably a clear and single answer to this. I think it's complicated. Axiom, I think we have over the years tried, I think one of our groups put out a publication called The Art of the Responsible Exit, really focused on this question. And we have tried both in our direct and fund sides to do that. And I think what that means is our first obligation, if you're in the fund context, is to your investors. You've made contractual commitments to return capital within a certain period of time. Perhaps you need to extend that if you have an extension available in your fund because of portfolio company factors. But at the end of the day, that timing we have bought into. That said, in that search, which will sort of begin well before you reach the end of the fund's life, that search for potential buyers, we are very cognizant of the types of buyers and their ultimate sort of impact on the portfolio company. And so we do try to find buyers that align with both what we were trying to do with the company and the business line of the business that's developed over time. And I think that second piece is important, that because we tend to be highly involved with our portfolio companies, if we've been successful during our 5, 7, 9-year relationship with the portfolio company, our hope is that what we've helped build has solidified in a way that our exit won't immediately cause a radical shift in the business away from impact. And again, that's highly, you can't ultimately control that once you're out of the company, but that's aside from who buys the asset from us, sort of what we've done with the company in that 5, 7, 9 years is I think critical as well.
So there's options, right? One option is what you've described, Kevin, which is finding that external investor. Edward, you've had some experience in actually using puts or mandatory redemptions where you've actually required the portfolio company to buy you out. How do you think of that in this context of exits and responsible exits?
Right. Now, I think the times we've exercised puts have been unique situations. I don't see any sort of impact conflict in the approach we've taken in exercising them. So I could get into the specifics, but in one case, there was effectively a fraud taking place at the company, and we and a DFI both exercised puts as part of a wind down of the company's business, and that was just a decision being taken by by DWM, the DFI, and then the original founder and sponsor of the company. And in another case, it's just it's again not impact related. It's a challenging investment with a founder, and there were expectations that we had about the exit we would make, the ability to market our shares, and we found ourselves effectively unduly restricted. and being able to find a buyer for the exit. We did have a put negotiated up front, and so we've exercised it, and it's amicable. I don't think it's created a particular problem for the company. It's effectively a decision made by the founder in this case to take the approach of having us exercise the put versus enabling us to more effectively market the shares to a buyer. So I certainly could see scenarios where you have a put and you're imposing it on a company in order to make your final investment and get out of the fund, and that could be damaging to the company's operations. It could be damaging the company's financials. It could be damaging, depending on whether the puts how the puts formulated, but and it could be damaging to the company's mission. There's no question about it. We haven't encountered that situation, and I think, like, I'm sure Aaron and Kevin would say the same thing. I'd like to believe that we're responsible investors. That's part of our mission, and so we would be taking that into account on some level before taking some kind of drastic action. Usually, it's just a lot more nuanced than that.
And I just add briefly, more sort of broadly, to, the end starts at the beginning, right? So you try to start thinking about exits when you're entering. But I think that if the selection of portfolio companies are such that there's this intentional impact embedded in it, such that the more success that portfolio company has, the more they sell, the more they do of whatever their product or service is, the more impact they generate, then that, if it's that embedded, then I think in terms of there's alignment of potential buyers at that end exit would be still aligned with it, because the impact is increasing as their fundamental product or service sales are going on. So again, if that's how you were picking companies, then that will be of interest to another buyer as well. So, they may or may not be intentional impact players, but it'll be in their interest to continue selling that product or service or that kind of model for higher impact.
Mm-hmm. It's interesting. So there are the exits because, as Edward was pointing out, it's a weak project. The portfolio company's running into trouble, and how do you take care of your own fiduciary responsibilities to your investors? But then there's the issues that Kevin was describing, which is, we're rolling up the fund, and we got to find others to now take fill our role as we move on. And then I guess the third is where, Julie, where you're heading, which is what are things that a portfolio company can do? So as a lawyer who's advising portfolio companies, as both all of you have started to highlight, it can be very destabilizing to the capital structure of a portfolio company if they are being forced to buy back their own shares, yet they get to maintain control, right? As opposed to having another investor imposed on them. For those who are really interested in this topic, last year's Grunin Prize winner, and we've got this on the Grunin Center website, created a new instrument that is sort of a self-liquidating investment structure that allows a portfolio company to be able to buy out its equity holders, essentially, but over time, and it comes out of a structured exit. And so that thought, as those who put that together at Womble Dickinson, it was really to sort of address this issue of how do you responsibly exit an investment without destabilizing the portfolio company. So this is not the situation Edward was describing where you've got a problem, you've got to find a graceful exit out to protect your investors, but this is the sort of turning it and looking at it from the portfolio company side and thinking about what are ways to have exits that don't destabilize the capital structure. So those interested, go to the Grunin Center website and look for the Grunin Prize, and you'll see a nice case study and description of that instrument.
Thank you, Deb. So actually, we're going to turn now to the former panel for a couple of follow-up questions. One of those questions is, Is there or should there be a focus on investing in systems change, especially in the developing world? Are impact investors focusing on a single product scalability rather than delivering systemic change?
Well, I have two of my panelists. Rob, do you want to come around?
Yeah, sure.
Could you repeat the beginning of that question?
Sure. Is there or should there be a focus on investing in systems change, especially in the developing world?
Well, again, that's a different sort of investment, I would think. We're talking about we have been talking about investment in particular portfolio companies. There are a number of efforts that I'm aware of, and you may be aware of others, to change regulatory systems or change reporting systems or change financial arrangements to make them more accommodating to these kinds of investments. But I'm not sure that when we talk about funds and we talk about private capital investments or even foundation investments, we haven't actually been focused on that. But as I said, I've heard of some of these kinds of attempts to more systematize the regimes across countries for these kinds of investments. Do you know of any of these?
I don't
Any thoughts? No.
thoughts, but I don't know of any examples.
Yeah, no, I don't know of any examples either. I think, this does get to a larger issue of how you conceive of impact, right? And there is a school of thought out there that says you should focus all of your efforts on emerging markets because, dollar for dollar, you have the most impact in that environment. There are other folks that say, we should be focusing on the Walmarts and some of the biggest multinationals that employ hundreds of thousands of people and affect millions of families, because if we can get one of those companies to change one thing that they do, the secondary and the second order, third order impacts are, immense, right? Arguably more than you might accomplish in an emerging market at a small startup environment. And so, I think you have to take a view one way or the other on that point before you get to systems change, or which systems to or change or not to change.
I want to open this up to the second panel as well, and I'm thinking particularly of Kevin and Aaron. You guys really are trying to affect systems change as you set up your impact investment funds and beyond. First, maybe start, Kevin, if you want to say something about the systems change that you're trying to foment, and then Aaron, maybe you could say another word about what you guys, it's the theory of change of your fund, why you even are doing it. Go ahead.
Yeah. No, I think that's a good question, and perhaps it goes to the question of what systems are we trying to change. So in our case, our fundamental premise is that the financial system has not worked for a large swath of the global population. So that is our working thesis. I think it's you look at numbers coming from World Bank, et cetera, about access to appropriate financial services and then use of those services by sort of the base of the financial pyramid, and the numbers are quite low. So our thesis around the way that plays out in terms of our mission is that we're working to not sort of orient the existing financial system towards that crowd, although ultimately that might happen. And you see that with sort of your traditional financial commercial banks and others trying to now leverage financial technology, et cetera. What we have been focused on doing is to build a financial system that does respond to the needs of the poor, and not just historically that's been microcredit, but that in and of itself is not enough. We want them to benefit from all of the products and services that probably everyone listening in and participating in this discussion benefit from. So for us, that is a huge systemic change. But the way that we accomplish that is by directing capital at the company by company level, so that those individual products and services and the financial service providers that offer them can grow, can scale, and can ultimately, again, provide that systemic change away from what is the norm.
And Erin, do you want to say a word again? Because I think you are doing that, but you also want to show the world that capital can be deployed this way beyond just what you've been able to attract.
That's right. I mean, from a purely habitat perspective, we're looking to eradicate poverty housing, and we know that we can't do that as just a single organization, that we have to get a number of other actors on board. And we have to, in fact, change the marketplace so people start thinking about housing as a priority. So the way microbill ties into that vision is by deploying the capital that it gets from OPIC to microfinance institutions to develop housing products, either grow existing portfolios of housing products or create new portfolios. And so that's one sort of level of leverage or sort of scale, if you will, where we do something beyond what Habitat can do all by enlisting these MFIs. And then we demonstrate further that because of the success of these MFIs that have used the capital that Habitat or Microbuild has deployed, maybe other institutions will follow suit and start coming up with other different housing-related finance products. And use them in conjunction with technical assistance to develop an entrepreneurial products such as roofing and flooring products and innovations to sort of solve the housing crisis together, rather than just sort of Habitat trying to do it all by itself by raising money in the U.S. And we see Microbuild as really it's still a pretty small step in that direction, but we do see it as a step, and so far it's looking pretty good.
Yeah, and related to what you're saying, Erin, I think one of the things I've learned from participating in the Microbuild Fund is that in some countries, the very fact that the micro entrepreneurs are improving their homes helps them secure greater land or security over the ownership of where they're operating, particularly in systems where the mortgage system and land title is a lot harder to establish. Sometimes these home improvements can actually make people more secure in where they're living. So, again, I think it really depends upon how people are setting these funds up and what their theory of change are. And sometimes it can be very system oriented, and sometimes it's just we are pushing capital into companies that need the capital for growth. And we hope that there will be wonderful things that come from that.
We're out of time.
Even now, out of our later time.
So unfortunately, there are just a couple of questions we couldn't get to. If you'd like to discuss these with us, please feel free to reach out. For everybody else, and especially our panelists for joining us today, thank you. It's been a pleasure to work with you, and we look forward to future webinars and continuing this conversation.